Invest Africa, proudly brought to you by KPMG.
Hello and welcome to this week's episode of Invest Africa. I'm Nozi Pumbandra. A KPMG report on the insurance business in Africa shows that insurers are targeting Africa for growth. But the insurance industry has undergone recent changes, particularly in Kenya. Philani Nyalunga compiled us this report.
One of the factors constraining the insurance business in Africa is often well-intended amendments regulation of the industry. But despite that, the sector is poised for growth.
One of the major risks posed by the insurance industry, if you look at a survey done by quite a few of the firms, regulation is one of the major problems which many industries are facing, especially the insurance industry. It has to be managed. The regulator has interest in terms of making sure that the best practices are followed. But sometimes it also happens that the realities are not really in touch with the realities of the world. You might want to have a best practice to be installed in a particular country, but you may not have the sufficient infrastructure ready for that.
It's reported that business insurance is more developed than personal insurance. Another problem facing the industry on the continent is an underdeveloped distribution network.
South Africa is one of the few countries where you have thousands of insurance brokers going out there marketing these products. In Africa, generally you get your insurance either through a bank or a large international broker, which again doesn't service your smaller business that effectively.
Terrorism is a new challenge facing the insurance business. Such incidents are not that common, so it's not everyone who will consider such insurance cover.
Terrorism is tricky. Obviously, it's a globally a problem of many sorts. Obviously, terrorism is still quite rare, okay? So it's not I doubt it's a primary consideration when people are looking for insurance. And also, even though when it happens, it's very tragic, it's not a huge component of your insurance premium. I mean, the realistic thing is fire or flooding or something is a lot more likely to hurt you than terrorism. So I don't think it's going to have as big an impact on the market as some people might think.
Insuring property against the act of terror is expected to grow significantly following Kenya's Westgate Mall siege that left about 67 dead and 175 people injured. However, it has emerged that many people whose property was destroyed during the Westgate Mall attack on the 21st of September may not be compensated by their insurers. Suresh Kumar, a principal officer at AP Insurance in Kenya, says that those customers whose properties were not insured against terrorism might find it difficult to get compensation.
Terrorism is a separate extension which has to be taken as part of your regular policy. There is an extra premium, albeit a very small premium. For instance, a car which is worth 1 million shillings, the premium could be as low as 2,000 shillings for a terrorism extension. Unless this extension is taken, insurance companies would find it difficult to compensate the loss, mainly if it's a very large loss.
KPMG says the ongoing regulatory change agenda, the renewed need for increased growth, profitability, capital returns, and cost reductions remain central themes for the industry. It advises insurers that success will come to those who manage these challenges with an eye on creating positive value for enhanced performance. Philani Nyalunga, CNBC Africa, Johannesburg.
Despite the regulatory challenges in the insurance sector, it is still poised for growth, especially in Africa. Joining me in the studio now to unwrap the sector's potential and hurdles on the continent is Margaret Dawes. She's from Sanlam Emerging Markets and she's the executive director there. Next to her is Tava Madzenga. He's the CEO of Old Mutual Africa. And next to me, I have Adam Sami, CEO at Line of Africa. And in our Lagos studios, we're joined by Yomi Onefare, and he's the divisional director for retail business at Mountsaad Insurance. Thank you, everyone, for making the time to join us, and welcome to the show. Let me first come to you, Tava. What's driving the growth of the insurance industry in Africa?
Well, I think the starting point for us is maybe to look at the customer and say, what are the customer needs that people are facing in Africa? And what you find is that those needs or the risks they face are really not any different to other parts of the world. And so people are facing issues to do with death, illness, loss of property, and so pretty much the same customer needs. I think the real difference is how are people meeting those needs? And you find people are using, borrowing money, savings, or doing absolutely nothing. And I think that's a very inefficient way to deal with these risks. And I think that's what actually then creates the demand for insurance. And I think you will start to see that various insurance companies are dealing with these challenges of how to provide and to meet those needs in very different ways.
Margaret, would you agree with Tava's assessment of what's driving growth and taking into consideration Africa's economic growth story, the growing middle class? Is there a little bit more to why we're seeing the rapid expansion of insurance companies into Africa?
No, Sipa, I think the point you make about the emerging middle class is particularly relevant in this instance. I do agree with Tava. Clients' needs are prime in terms of understanding what's driving insurance, but insurance penetration across the continent is extremely low. There's huge potential for growth just because of that, and the emerging middle class is obviously bringing opportunities that we didn't have before, both from a general insurance point of view and from a long-term insurance point of view. Many people have never had an opportunity to buy life insurance products before, and they're learning about the need and the ability, the access to protect themselves. So we are seeing an increase in interest in insurance everywhere.
And perhaps let me put it differently to you, Adam, and ask the question from the point of view of what makes African markets attractive for the business?
Okay, now Line of Africa is a commercial insurer to industry. And so we have a slightly different focus in terms of who our customers are. What we are seeing in Africa, not dissimilar to South Africa, are extremely large investments in infrastructure. Infrastructural development is leading the charge for the growth of markets in the continent. And what you then have is in the domestic markets in Africa itself, there is a need for greater expertise in the underwriting of such risks. And capacity to insure those risks in Africa. Insurance at that level is a global play, and so usually what you've seen is external, mainly international players who've come in to insure some of those risks. And that also accounts for the comment around why there is such a large presence of international insurance intermediaries in Africa, and they're basically looking at those risks. So I think that, I mean, from our perspective and from companies that play in our segment of the market, we see Africa as an opportunity to bring African skills into Africa and to hopefully help to keep African resources and African premiums in Africa for the development of Africans.
Perhaps let me take the conversation to Lagos, to you, Yomin, and I'm hoping that you can talk to us about the penetration rate that Margaret raised in her comment, and understanding that in Nigeria there are specific challenges around getting the 165 million inhabitants insured. Talk to us a little bit about the regional trends and where the Nigerian insurance sector is going.
The challenge with regards to penetration rates has partly to do with the lack of financial inclusion within the Nigerian environment. So where you have in Nigeria, for example, banking industry has made certain leaps and bounds over the last couple of years. Insurance has not quite been that fortunate. As of 2007, the industry started to make new inroads, largely on the back of increased capitalization. But the level of capitalization is still so low relative to the amount of investment needed for distribution. And you find that ability to sell products within the rural areas, for example, comes at such very high cost. Infrastructural challenges, lack of adequate support from the regulator, awareness is low. We're competing in the market where you're paying the same rates for advertisement as the telcos and the banks. So cost of distribution generally is very high, coupled with the lack of skilled manpower in the industry. So yes, penetration is low, but what we've seen over the last couple of years is the improvement within the middle income segments where more people have a bit more to save, they have the ability to plan better, they're now beginning to see the potential to use insurance as a better coping mechanism than the traditional values of leaning on extended family.
Now, Yomi, let me come back to a point that was made in the short clip that was played, and this was around terrorism not being a major factor when one considers whether they go into a specific market. Now, in addition to the Westgate saga that happened in Kenya, about 2 weeks later, we also had the terrorist activity in Nigeria, in Yobe State, that happened around that school. Now, for a Sanlam and for an Old Mutual, is what we heard earlier an accurate reflection of the process you go through now as you consider the risk profiles of new markets? And let me start with a response from you, Tava.
Well, I think we certainly can't ignore terrorism. I think it's a global threat, but I think we need to look a little bit broader than just terrorism. I think the needs of the people across the African continent are not simply affected by terrorism. I think terrorism is fresh in our minds because of the tragic events that have happened in Nairobi. But I think when we look at insurance and you look at our businesses, which are close to and more than 100 years old, they have survived and gone through various cycles of events, 2 world wars. And I think this is another phase. And so our business is really long-term insurance. And I think investing in Africa does call for a level of strategic patience.
I see Adam nodding his head emphatically next to me, so I'll let you come in, but once you do, I also want you to take on this expectation of goodwill that we've heard coming out of Kenya. There was extensive reportage coming out saying that the insurance industry should unite with the Kenyan people and show some goodwill and maybe forgo some of the business interests in light of uniting with the people. Now, what are your views on that? But first, let me get your head nods in.
Well, I want to agree that terrorism can't be the overarching factor, and it can't be the single reason for us to do business in any territory. We cover a range of perils. Terrorism is up there. It certainly is an important one because it has major impact on country markets, perceptions around developments in a country, and therefore will impact extraneous things like tourism and that sort of thing will come through, and it can impact an economy very, very negatively. And so one should not downplay it. In South Africa, we have a nationalized institution where we have a government-owned company that does nothing else but insures terrorism risks. And I think that's part of the kind of thing that we can export, kind of ideas that we can talk to in particular territories and with particular countries in terms of the way that they can deal with the financial and economic loss. In the clip that we saw, for example, there were issues around now, do insurance companies pay for it and don't they pay for it, and so on. And certainly from a commercial perspective, no sound commercial entity should have an insurance which excludes the impacts of terrorism and so on.
Before we go to the break, I want to maybe bring you in, Margaret, on a different aspect of the insurance in Africa. Yomi raised the point of difficulties around the distribution channels. Now, how is that in turn changing the business model? We all know that Africa, when it comes to distribution channels, which I'm assuming are underpinned or should be underpinned by strong infrastructure, that we have a bit of a dearth there. So how are businesses circumventing those infrastructure deficits to ensure that they still get product and service to the customer?
Distribution is obviously key in our industry, as everyone has said. We work on diverse distribution channels for different market segments, and we try and get our products to customers as cost effectively as possible. So we're always looking for the most economical distribution channels that we can find. Technology can be a challenge. Power on and off in various places makes it difficult to be IT connected everywhere that you need to be. But it's improving all the time. So we move with the country, we adapt as we go along. We use banks for distribution quite extensively. We're more and more using mobile phones for distribution as well. We have established agency forces in most of the countries, so we don't just work through brokers. So in most countries they have a sizable agency force, and they go out into the rural areas in Nigeria, in Ghana, in Kenya, etc., and they actually sell on a one-to-one basis.